All right, well, Thanksgiving is behind us. We had a holiday shortened trading week last week. The question now is, are we in for a Santa Claus rally? I will look at the charts and figure out what is likely to happen. We'll do an analysis of the overall market, and then we will look at the day trade of the week on LIDR. So there is a tendency for markets to rise in December, and this has been called the Santa Claus rally. You see it often. You have this optimism that comes into the market after the Thanksgiving long or shortened week, long weekend in many ways, and you often get this rally into the end of the year. So the question is, will that happen this year? Well, you have a lot of people saying on the other side of the argument is that we are going to have a lot of tax loss selling. When someone has bought a stock earlier in the year, they're losing on it. They want to crystallize that loss to offset against the gains that they may have had to lower their overall taxes. Well, the reality this year is that there's not a lot of people with significant profits from earlier in the year. Most stocks have gone down. In fact, most sectors of the market have performed poorly. So is there really a motivation to crystallize tax losses to offset against gains when there's not a lot of gains out there? At the end of the day, I don't really care what the argument is. We can make arguments for one side or the other. All that really matters is what are people actually doing with their money? And to get the answer to that question, it's easiest to look to the charts. So let's take a look at the chart of the S&P 500. This is a 5-year weekly chart, and you can see that we are in a downward trend. We started this downward trend in January. We moved up in the spring, and then moved lower into the summer, and then rallied mid-July into August, and then down, and then the last 4 or 5 weeks we have been moving up again. So you can see that the cycle of strong downward moves followed by shorter term upward moves is still intact. Also notice from this chart that we are at the downward trend line, and every time we've hit that downward trend line, prices have rolled over and headed lower. And so the question then is that going to happen again? Well, at this point, we don't have a break of the upward trend line. You know, back there in August, we had a break of the upward trend line and we fell lower. And then here in, I don't know what that was, March, we had a break of the upward trend line and then we went lower. So we don't have that yet. All that we have is a market that's rallied into resistance, and we know that there is a tendency for markets to get stuck and move lower when they rally into resistance. So that's what should happen. And now what I'm looking for is this happening? Are we getting a break of the upward trend line? We don't have it yet. It's likely to happen because it tends to happen, but that doesn't mean it will happen. So I would say there is a 65% chance that the market is going to stop going up here, roll over, and move down into the end of the year. However, until you get the breakdown, the trend is up in the short term, and therefore I would stay on the slightly optimistic side. Now, why slightly optimistic? Because we are still in a downward trend going back to January. We haven't broken that downward trend line yet. Till we do, don't get optimistic. Until we break the short-term upward trend line, don't get pessimistic. All right, let's take a look at the overall markets now and get a sense of where things are at. And this is the first chart that I want to look at. This is the shorter term chart of the S&P 500. And you can see that in the short term, the buyers are in control. We know that because there's rising bottoms on this chart. So over the last month, the buyers are in control, so it looks fairly good. The problem arises, as I said earlier, when we look at that longer term chart, we are stuck at that longer term downward trend line, and I worry that we're going to see the sellers take over there. Let's take a look at the small cap stocks in the US, IWM, and we'll take a look at the 3-year chart there. And there you can see a little bit different pattern. The pattern is one where you have a double bottom. So this low here is basically the same as this one. And that's a little bit more of a bottoming pattern. You can see that the downward trend line was broken, and then we made a double bottom, and now we're trying again. So the small cap stocks in the US look a little bit better than the larger cap stocks that make up the S&P 500. Now, much of that is because of the weakness in the NASDAQ. And so let's take a look at the NASDAQ market. QQQ is the ETF there. We'll take a look at the 3-year weekly. And you can see that unlike the S&P, it's still a little bit below that downward trend line. So we want to be aware of that fact. If this downward trend line can be broken, that's great, but we're still below it. I think that's what's dragging on the market, is those large cap tech stocks. Now, one thing I've noticed in the past week or two is that the semiconductor sector, which really was hurt by supply chain issues, not being able to get the stuff that makes semiconductors, while that sector has started to turn up, we saw some life in it the last couple of weeks. You can watch that thing by looking at SOXX, which is the semiconductor ETF. Look at a 3-year chart of that. And you can see over the last 3 weeks, some real good strength, sort of breaking the downward trend line. It's kind of right at it, but that could help that NASDAQ get better. All right, let's take a look at the Canadian markets now. T.XIU is the TSX 60. Take a look at the 1-month chart, and you can see here we are in an upward trend on the 1-month chart of the TSX 60, so the buyers in control in the short term. In the longer term, that 3-year weekly chart, we have managed to break the downward trend line. We're still stuck below resistance, but the sentiment stock score is 86. That's pretty strong. We've been below that critical 60 mark for most of this year, and held up a little bit better than the US market because of the oil and gas sector, which is quite dominant in the Canadian market. All right, let's take a look at the market for the US dollar, UUP, and you can see there it's been weak over the last 2 months. I'll explain why in just a moment. How about the Bitcoin market, GBTC? Still ugly. Let's take a look at the 1-month chart there. It has really sold off as those concerns around the FTX exchange going bankrupt, essentially, maybe perhaps being a bit of a scam. And so it's based out from being a little bit oversold, but if we go to that 3-year weekly chart, you see it's still a pretty ugly chart. All right, how about how that US dollar translates into commodities? Because if the US dollar is falling, it makes commodities cheaper. So let's take a look at GLD, which is gold. And you can see that gold has been moving up while the US dollar was moving down. That's to be expected. Looking at the 3-year weekly chart, you can see that the downward trend line has been broken. It is not doing so from a rising bottom. So without that rising bottom, we sort of lack the real strong signal that the market is based, but it's still a pretty good sign that gold is getting better. And so you might look for opportunities in trading the gold mining stocks as they are getting the benefit of rising gold prices. Not just gold, by the way, silver as well. So what about oil? Take a look at USO, which is an ETF that represents oil. Here's the 3-year weekly chart. This upward trend line, if we just imagine a line along there, it's really been tested. And this week, actually last week, we started to break down from a falling top. And that's why I lowered my rating on oil. Now it still has support here at the horizontal support line, but it is a bit worrisome for the chart of oil. And then finally, let's take a look at the interest rate chart, TBT, and you can see that interest rates have been pulling back for about 5 or 6 weeks. That is supportive for stocks. That's one of the main reasons why stocks have done fairly well over the last month. However, we have to look at the long-term chart of the US Treasury market, and you can see that it still is in an upward trend. We got overbought because the trend line ran up and away, and now we're pulling back down to it. The question is, are we going to bounce off of this trend line, or are we going to break down through it? My sense is that we will come back to that longer term upward trend line. We'll bounce. So interest rates aren't necessarily going to go down a lot more, but they're probably going to stabilize, because anytime a trend goes parabolic like this, you can see the trend really went parabolic, it typically doesn't break the downward trend line. It just goes sideways for a bit, and then it's the break of a downward trend line from a falling top that is the signal of a reversal. So I think we're probably just going to see interest rates sort of stabilize, certainly be higher than they were a year ago, but maybe stop going up with such velocity as we had seen. All right, so let's take a look at my ratings then. Very similar to last week, a slight change here and there, but generally neutral in the long term, bullish in the short term. for US stocks, Canadian stocks, gold. Oil, I'm neutral long-term, bearish in the short term. It is got a little bit of weakness over the last month. The US dollar neutral long-term, bearish short-term. Bitcoin bearish in both time frames. And interest rates I put as neutral long-term and bearish short-term. Once we get back to that upward trend line, we may see the bull trend in interest rates take over again, but I think we're probably going to just go sideways for a bit there. All right, let's take a look at the day trade of the week now. And of course, it was a shortened trading session on Friday, no trading on Thursday. One of the things I like to look for are signs that a stock is getting attention. And so you can do that on multiple time frames. Now, normally when I look at the day trade of the week, I don't talk about the longer term time frame. But what's key to my approach to the market is to always consider multiple time frames. In the interest of time, most weeks I don't do that because that's things that we talk about in my Active Trader live webinar that runs every day. With this stock, LIDR, it really showed how this is important. You see here there's a pink dot. That was the start of the day on Friday. That pink dot with a yellow inside is my own indicator. It's called an action candle, and it indicates that the buyers were strong early in the day on LIDR. And so what I look for then is if the longer term time frame is telling me to think about buying this stock, the long term time frame tells me what to do, and then I go to the short term time frame to tell me when to do it. So now on screen you see the 1 minute chart. So it moved up to start the day, and then it went quietly sideways, and then it came alive again around 10:45, 10:50, and that's what started this big upward move. So the long-term time frame came alive early. That's what made us watch it, and then it got quiet, and then we waited for the next wave of buying to come in on the shorter term chart, and this is the 1 minute chart, and that then led to a very strong gain, one of the few stocks that could manage a big gain on a very quiet trading session. Well, hope that you've enjoyed this week's Market Minutes. If so, click on the like button, leave a comment. Do you think we're going to get a Santa Claus rally, or will it be a lump of coal for the stock market? And most importantly, make sure that you trade well.